Welcome to the audiobook cut for the psychology of money. Timeless lessons on wealth, greed, and happiness by Housel. In this cut we will summarize the book and pick the main points such as how individual experiences impact investing, why having one winner to 99 losers is okay, and how jealousy causes investors to risk all they have. We cut out the key bits so you can efficiently benefit from the expert guidance given in the book. Let's get into it. How can one participate in the stock market? When is the greatest moment to purchase assets, and when should they be sold? If you want to retire at a specific age, how much money do you need to put away each year? How do I gain an understanding of the psychology that underlies financial choices? Questions like this seem to come up most often when people are talking about their own finances. However, there is often a significant component that is missing from the equation. This is the human element, or more specifically, the connection that exists between actual people and the money that they have. According to Housel's argument, this aspect is essential to comprehending the process of making financial decisions. If you want to know why people bury themselves in debt or waste fortunes, you don't need to study interest rates, you need to dive into the all-too-human history of wealth, greed, and happiness. We each have a unique perspective on the economy and money. Do you know what happened during the Great Depression in the US? Following the catastrophic collapse of the stock market in 1929, the economy of the whole world went into a prolonged fall over the next decade. The decade known as the Roaring Twenties came to an abrupt end in the United States. Companies went out of business, people were evicted from their farms and houses, and the money that had been saved up vanished into thin air. Poverty and joblessness reached all-time highs, but trust that the next day would be better than the previous one fell precipitously. This interpretation of what transpired has evolved into the accepted narrative at this point in time. That makes perfect sense, considering how accurately it portrays the lives of millions of people in the United States. However, by doing so, one essential component is missing from the image. The most important takeaway from this blip is that everyone has their own unique perspective on money and the economy. During his campaign for president in 1960, John F. Kennedy was often questioned about how he had personally coped with the Great Depression. Many voters were taken aback by his response. According to what he indicated, the Kennedy family was financially prosperous in 1929. And throughout the course of the subsequent 10 years, their wealth did not diminish at all, rather, it increased. At the beginning of the decade, the family had fewer servants, but by 1939, they had increased their staff and moved into a larger home. It wasn't until he got to Harvard and studied about the Great Depression that he became aware of how severely many of his fellow Americans had been affected by the economic crisis. He found out that not all Americans had been in the same boat at the same time. That was something that John F. Kennedy wanted to alter, and it was one of the reasons why he was able to persuade folks that he wasn't simply an elitist who was out of touch, but that he should be president. But the affluent and the poor aren't the only ones who have differing experiences of economic life, all of us do. Not only do the son of an unemployed farmhand and the son of a wealthy Manhattan stockbroker come from quite different walks of life, but they also receive very different lessons about things related to money, such as risk and reward. However, the same principle applies to persons who are equally well off depending on the specific life experiences they have had. For instance, a person who grew up during times of high inflation would have a distinct financial perspective in comparison to a comparably rich person who has only ever seen periods of stable pricing. This is because the former has had more exposure to fluctuating prices. The financial decisions that we make are influenced by the lessons that may be drawn from these varying points of view. We all want to believe that we have a firm grasp on how things operate in the world, but in most cases, our experiences don't even begin to scratch the surface of the whole picture. When it comes to the psychology of money, this is the first thing to grasp. Despite our best efforts, we do not know as much as we would want to believe we do. When modeling financial behavior, economists often depend on a convenient fiction, which is the concept that rational beings make choices that are self-interested and want to maximize their gains. This theory is simpler than the reality, which, of course, is messy. Take, for instance, the case of the lottery. In the United States, households with modest incomes spend $411 per year on lottery tickets, on average. During this period, around 40% of all families are unable to come up with $400 in the event of an emergency. It should come as no surprise that this 40% of the population consists of the same low-income households who spend approximately $400 a year on lottery tickets. This behavior doesn't seem rational, does it? However, this does not make it unreasonable in any way. If you are living paycheck to paycheck, it is quite doubtful that you will have enough money for even the most basic of necessities, much alone for pleasures such as going on vacation. Playing the lotto may be a long shot, but it's better than the alternative, which is to have no chance at all of receiving the wonderful material goods that more financially secure people take for granted. The takeaway here is that personal experience is the primary factor in financial decision-making. It happens more often than you may expect that people will make calls that are unreasonable. This information comes from a research that was conducted in 2006 by economists Ulrika Malmendier and Stefan Nagel. They searched through 50 years' worth of data that had been produced by the Survey of Consumer Finances, which is an ongoing research project that investigates how people in the United States handle their personal finances. Malmendier and Nagel were interested in finding out what factors influence people's decisions on how they invest their money. What is their response? What the state of the economy was like when the investors were in their early 20s. To put it another way, our perspectives on risk are shaped by our individual histories. In the same way that purchasing lottery tickets is not the sort of rationality found in economics textbooks, this is not the kind of rationality that is immediately reasonable. For example, if an investor was in their late teens or early 20s at a time of strong inflation, it was very unlikely that they would invest in bonds later in their lives. If, on the other hand, inflation was relatively low throughout these formative years, investors were content to continue putting their money into bonds as they got older, regardless of whether or not inflation increased along the way. A similar tendency exists for stocks. When people reached early adulthood and the stock market was doing well, they continued to put money into it. When it was performing poorly, at the same age, they stayed away from it. If you were born in 1970, the S&P 500 climbed by a factor of 10 during the time that you were in your mid-teens and your early to mid-20s. Anyone who invested their money in the firms that were listed in that stock did extremely well for themselves. People who were born in 1950 had a totally different experience of the market, which was essentially inactive throughout this era of their lives. Importantly, judgments on whether or not to invest did not alter even when the market itself changed, which suggests that data from the actual world did not have an effect on instinctive decisions that were made early on in life. The economic ideas that we make use of today are still quite young in historical terms. The toy poodle has little resemblance to its wilder ancestors, which were not all that unlike in appearance to wolves. This shouldn't come as a surprise to us given that the history of domestication of today's canine breeds dates back more than 10,000 years. Despite this, dog owners are sometimes taken aback by the natural and bloodthirsty behaviors of their dogs when they see a cat or a squirrel. It seems that 10 millennia have not been enough time to eliminate these deeply ingrained wild characteristics altogether. However, what does the domestication of dogs have to do with the psychological aspects of financial matters? In point of fact, quite a bit. Why are so many of us so terrible at managing our financial resources? One possible response to this question is that, in the greater scheme of things, it is still relatively new. Around the year 600 BC, King Aliats of Lydia, an Iron Age country located in what is now Turkey, began minting his own coins, which is generally regarded as the beginning of monetary history. And this is nothing in comparison to some of the more complicated economic ideas. And the idea of retirement. Prior to the Second World War, the majority of Americans continued to work until the day they passed away. Of course, people had shorter lives back then, but even so, in the 1940s, males over the age of 65 made up 50% of the workforce. This was despite the fact that life expectancy was lower back then. Things began to change after World War II with the creation of Social Security, but retirement remained an unachievable dream for the majority of American workers until the 1980s. The 1980s was the decade in which the average monthly Social Security check increased beyond $1,000 when adjusted for inflation. Prior to then, only a select few members of society could have the financial means to retire in their mid-60s. That indicates that one of the most fundamental economic ideas that we use in the modern world is not even close to being 2 generations old. It wasn't until 1978 that the 401k, which is now the most common way to finance retirement, was established, and it wasn't until 1998 that the Roth IRA, another retirement plan, was made available. A number of other essential concepts and procedures are not that much older. Index funds have been around for just around half a century, whereas hedge funds have only been around for about a quarter of a century. Even consumer debt, such as mortgages, auto loans, and credit cards, which is one of the key drivers of economic development in the United States, did not become prevalent until after the GI Bill, which was passed in 1944 and made it easier for normal Americans to borrow money. So, it's not because we're crazy, but rather because we're inexperienced, is the reason why we're often bad at financial planning and decision-making. You may not give luck nearly as much credit as it deserves for your financial success. In the last couple of years, the author posed a question to the economist Robert Shiller, winner of the Nobel Prize in Economics, what he'd most like to know about investing that can't be fully known. The response offered by Shiller was the exact role that luck plays in successful outcomes. The concept of luck is complex. There aren't many investors or business owners who would dispute the fact that it plays a part in theory, but it's difficult to define the exact degree to which it's responsible for one company's success while another company fails. In addition, we have the attitude that it is impolite to credit the achievements of others to pure luck alone. Because of this, when it comes to making choices about our finances, we often end up neglecting the part that chance plays. That is a grave error. The takeaway from this is that luck plays a far larger part in one's financial success than one may first believe. According to the findings of economist Bhaskar Mazumdar, the correlation between the incomes of 2 siblings is more than that between their heights or weights. To put it another way, if your brother is wealthy and tall, then you have a greater chance of being wealthy than you have of being tall. This association may be explained in a very straightforward manner. It is conceivable that siblings who were raised in the same home would be given the same advantages and chances. Parents who put one kid through a prestigious educational institution almost always do the same for the child sibling. However, if you locate a pair of wealthy brothers, you will find 2 individuals who do not feel that Mazumdar's research is applicable to their own family. That has to do with people's psychological makeup. We tend to either grossly underestimate or grossly exaggerate the importance that chance plays in events. If we are successful, it is because of the hard effort that we put in. If we are unsuccessful, it is because of the bad luck that we had. In the event that others are unsuccessful, we are not nearly as gracious. In situations like this, we don't put the blame for failure on poor luck, rather, we point the finger at character faults like laziness or narrow-mindedness. Unfortunately, the preoccupation with achievement that pervades our society isn't much assistance in this regard. Forbes does not laud smart investors who lost everything because they were unfortunate and the market had an unexpected drop at the same time. However, it does glorify poor or irresponsible investors who took a chance and ended up becoming very wealthy as a result. This puts us in a difficult position. When it comes to finances, we don't only need to find out what works and what doesn't, we also need a means to include randomness into our models. We need to discover what works and what doesn't. We may not be able to satisfy Shiller's ideal and account for the exact role of chance, but as we will show, we can get a hold on luck. Shiller was a pioneer in the field of probability theory. It is possible to improve the quality of your judgment by shifting your attention from individual examples to larger patterns. Bill Gates once made the witty remark that success is a lousy teacher. According to Gates, success leads intelligent people to ignore the part that chance plays in their lives, which in turn leads them to believe that they are invincible and cannot fail. Ironically, doing so is a fairly solid method to guarantee that you will come out on the losing end of the deal. The question now is how you should include elements of chance and luck into your financial behavior. Well, here's what you shouldn't do: fixate on the examples of certain people all the time. When we investigate very successful individuals, we often wind up selecting outliers, such as billionaires who have altered the way the world operates, and this might cause us to draw incorrect conclusions. It is helpful to focus on general trends rather than particular examples when trying to make judgment choices. Take, for example, John D. Rockefeller, who is widely regarded as one of the most successful businesspeople in history. When he first began to construct his petroleum enterprise, he came up against a challenge. The laws of the United States did not allow him to carry out his plans in the manner that he desired. Ignoring them was his straightforward response to the problem. His disdain for the norms of the legal system was so extreme that a judge said that his company acted no better than a common thief. The manner in which we think about this behavior is influenced by Rockefeller's level of success. When seen in retrospect, it is simple to laud his vision and assert that he did not let archaic regulations to obstruct the path to technological advancement. What if, however, he had been unsuccessful? If this were the case, would we still believe that Rockefeller's example is one that we should follow? Almost certainly not. At most, we would see him as a misguided criminal who demonstrated to us what actions are best avoided. However, when everything is considered, the only thing that differentiates these two results is chance. Rockefeller's fortunes may have been drastically different if he had received a few different verdicts, or if there had been a shift in the political atmosphere. Moreover, it is extremely difficult to reproduce one's good luck. Even if you were to carefully replicate every move that someone like Warren Buffett made in their career, there is no way to guarantee that the same opportunities would present themselves to you as they did to him. Therefore, here is another solution to consider: continue to focus on analyzing patterns of success and failure. The more widespread a pattern is, the greater the likelihood that it might be applied to the choices you make in your life and with your money. For example, study after study demonstrates that employees who have some degree of say over the flow of their days report higher levels of job satisfaction than their counterparts who do not. That is a generalization, in contrast to the rare instances of larger-than-life outliers, on which you may take action straight away. Jealousy can bring out the worst in people. Both wealth creation and the cultivation of envy are two things capitalism is very good at. Consider a young baseball player who is just starting out and earning $500,000 annually. He is wealthy by any and all reasonable measures. But let's suppose he's on the same club as a superstar like Mike Trout, who pulls in $36 million annually. All of a sudden, he won't be satisfied with the amount of money he brings in. He covets the things that other people have. While this is going on, top earners like Trout are always comparing themselves to those who make much more money. For example, in 2018, in order to be included on the list of the top 10 highest-paid hedge fund managers in the United States, a person's earnings for that year needed to be at least $340 million. There is nothing immorally wrong with jealousy when seen through the lens of capitalism. However, there is a logistical obstacle to overcome. The most important takeaway from this little quip is that being envious may lead to dangerous behavior. When do we know that we've had enough? Just ask Rajat Gupta. Gupta was born in a slum in Kolkata, India, and he eventually became the chief executive officer of the management consulting company McKinsey after working his way up the corporate ladder. When he finally hung up his boots in 2007, he was worth $100 million. Anything was possible given the circumstances. However, Gupta was green with envy. He set his sights on becoming a billionaire. As a member of the board of directors of Goldman Sachs, Gupta found out in 2008 that Warren Buffett was going to spend $5 billion to keep the company solvent amid the financial crisis. Gupta was aware of this information. Gupta dialed the number of a hedge fund manager 16 seconds after hearing this news on a conference call, long before it was made public, and purchased 175,000 shares of Goldman Sachs. This occurred long before the news was made public. This constituted insider trading, which is a criminal offense. Gupta didn't give a damn since he'd just earned a simple $1 million. A series of shady transactions had already netted him $17 million by the time the authorities located him and brought him to justice. Even while it hadn't made him a millionaire, it was enough to get him a substantial amount of time behind bars. What should we take away from this? The decisions driven by envy are often poor ones, and the losses incurred as a result are often far greater than the potential advantages. Consider the following. If you have an unquenchable need for food, you will eat until you feel physically ill. But vomiting is far more unpleasant than enjoying any meal, therefore you should avoid doing that. When you pass up possibilities, it doesn't always mean that you're losing out on anything, understanding that attempting to take advantage of every opportunity might not work out. To put it another way, don't make the same mistake as Rajat Gupta. It is far simpler to amass a wealth than it is to keep hold over it. Jesse Livermore was one of the best stock market traders in the early 20th century America, when it came to the stock market. He was born in 1877 and contributed to the construction of Wall Street. At the age of 30, he had already amassed an estimated value of $100 million in today's money. Just before the market catastrophe that occurred in 1929, Livermore made the finest choice of his whole career when he gambled that stock prices would go down and opened a short position. Indeed, the market saw a drop equal to 1/3 of its whole value. During the time when fortunes were being lost, Livermore went home to his family with some very good news. Meanwhile, the story spread that insolvent investors were jumping from office windows. He'd just earned what was then the equivalent of $3 billion in today's money. Happy ever after? Not exactly. Accumulating wealth is far simpler than successfully maintaining it. Do you remember what we mentioned before about how success is a lousy teacher? After such a decisive victory in 1929, Livermore was certain that no one could defeat him. He continued to gamble his whole wealth away by placing ever larger wagers and experiencing the same devastating outcomes over and over again. In 1940, he committed suicide in a Manhattan club when he was penniless and saddled with debt. As it turns out, being wealthy is often a great deal less difficult than maintaining one's wealth. It is not difficult to see why those who are skilled in the former frequently have difficulty with the later. Making money requires a certain level of bravery, optimism, and risk-taking. Keeping money requires a very different mental approach than making it. It's the worry that all you've worked for may be ripped away from you in an instant. Maintaining one's wealth requires one's humility as well. After 1929, Livermore began to believe that he was a genius who never made a mistake in his life. It would have been to his advantage to acknowledge that good fortune had assisted him, as well as the fact that he could not continue to enjoy the same level of success permanently. There are many people in the world like Livermore, but their histories are not often as terrible as his. Approximately 40% of all publicly traded firms end up completely losing all of its value over time. In addition, there is a 20% turnover on the Forbes 400 list of the wealthiest individuals in the United States every decade. This statistic does not take into account deaths or transfers within families. So the question is, how do you hold on to what you already have? To sum it up in a single word, persistence. The most successful entrepreneurs are those that remain in business for a significant amount of time without going bankrupt. Fear is the one element that unites all of these people in one way or another. When you're anxious about failing, it colors how you evaluate opportunities for success, according to Michael Moritz, a venture capitalist who is worth several billions of dollars. there are hardly many opportunities for profits that are substantial enough to warrant taking the risk of losing what you currently own. And when you do so, you are far more likely to arrive at decisions that are in your best interests. Even if you are wrong half of the time, you can still amass a fortune. Heinz Berggruen did not show a great deal of potential when he was younger, according to his own recollection. When he was finally able to escape Nazi Germany in 1936, he did not know what to do with the rest of his life. After graduating from the University of California at Berkeley with a degree in literature, he began his career as a journalist and dabbled in art criticism in his spare time. In 1940, he spent $100 to acquire a little watercolor painted by an artist named Paul Klee. It was the beginning of an obsession with contemporary art that would last a lifetime. By the time we reached the 1990s, Berggruen had established himself as one of the most successful art collectors in the history of the hobby. In the year 2000, he parted ways with his collection by selling it to the German government for 100 million euros. Because it featured a significant number of works by artists such as Picasso, Klee, Matisse, and Braque, the value stated was not even near to what it was really worth, which was believed to be $1 billion. It was without a doubt one of the most significant collections that had ever been assembled. How did Berggruen accumulate such a remarkable collection of work by the most accomplished painters of the 20th century? Was it talent or simply luck? Horizon Research, an investing company, offers a more intriguing response to that question. According to the findings of the company's study, all significant art collectors engage in the same practice, which is to purchase enormous numbers of works of art. Some purchases end up being fantastic investments, particularly if the collector holds on to them for an extended period of time. The vast majority, on the other hand, are worthless. According to the findings of Horizon's analysis, the challenge lies in maintaining the former until the return on the portfolio, which represents the worth of the whole collection, converges upon the return of the best elements in the portfolio. Berggruen's collection was somewhat analogous to an index fund in that his risks were distributed uniformly among a diverse selection of assets. Instead of just purchasing items that he liked or admired, he purchased everything that he could get his hands on and waited until a few standouts emerged from the collection. This tactic is applicable to all forms of investing. The propensity for a relatively small number of events to account for the bulk of outcomes is often referred to as the long tail. When broken down into its component parts, this idea is deceptively simple while being underpinned by a great deal of mathematical complexity. In general, when you have some successes under your belt, you have greater leeway to fail at other endeavors. The quality of your triumphs is much more important than the fact that you will inevitably experience failure. To put it another way, if you have one Picasso in your collection, you don't have to worry about the other 99 pieces, even if they're not as good. The process of making decisions about money in the actual world is far more complicated than what is presented in economics textbooks. There are a number of actions that aren't logical, but they nevertheless make sense in their own way.